WTI appears to have reversed course since last week and now appears to be moving in an upwards fashion. Currently, we tend to focus on the situation of the US oil market and also keep an eye on China as well as the international supply side of the oil market. In this report, we aim to shed light on the catalysts driving WTI's price, assess its future outlook, and conclude with a technical analysis. We note last week's comment about the problems in the supply side of the US oil market given the continuation of the extreme cold weather phenomena. The Baker Hughes oil rig count remained stable at 499, implying that last week's increase in the number of active oil rigs by 2 appears to be satisfying current demand. API, on the other hand, seems to partly validate that hypothesis by reporting on Tuesday an increase in oil inventories, implying that production was able to catch up and exceed demand, which may suggest that the US oil market may be loosening. Yet the increase in oil inventories was lower than what was expected, coming at 0.647 million barrels, which may have mitigated the downward pressures exerted on oil's price. However, the EIA report, which was released a day later, reported a significant increase in oil inventories by 5.520 million barrels, vastly exceeding expectations of 1.7 million barrels. The figure may be implying a reduction in demand for oil or that supply is vastly exceeding demand. In conclusion, it could appear that the US oil production sector is exceeding demand, which according to the EIA peaked during December 2023 and is now expected to decrease slightly through the middle of 2024, thus potentially exerting downwards pressure on oil prices for the first half of 2024. On the demand side, we note that China's PPI rate for January came in better than expected at -2.5% versus the expected rate of -2.6%. Yet despite the better-than-expected PPI, it is still in negative territory, implying deflation for producer prices for the past 16 months. Moreover, the CPI rate for January came in lower than expected at -0.8%, indicating deflationary pressures which in turn may imply weakening demand within the Chinese economy. As a result, the worrying economic situation in China could spark fears about future demand from the oil guzzling giant. Therefore, should further financial releases hint at economic deterioration, it could weigh on oil prices from a demand-side perspective. On the supply side of the international oil market, we know that oil prices may have found some support as the possibility of oil supply chain disruptions in the Middle East appears to be on the rise. According to various news organizations, Israeli Prime Minister Netanyahu's comments appears to have been interpreted as a sign that the conflict in the region is set to continue, which may have dampened traders' hopes of easing tensions in the region. Moreover, Houthi rebels appears to be hell-bent on disrupting trade via the Red Sea by claiming to have struck US and UK ships in the region. Should these actions be officially acknowledged by the US and UK, it could lead to retaliation by US and UK forces, thus further disrupting the oil supply artery. Therefore, the possibility of the conflicts being prolonged well into 2024, it may provide a slight boost to oil prices. The commodity appears to have moved higher since last week, with it now taking aim for the 75.25 resistance level. We maintain a bullish outlook for the commodity, and supporting our case is the crossover of the 100 moving average line above the 50 moving average line, implying a switch towards a bullish market sentiment. Moreover, the RSI indicator below our chart currently registers a figure above 60, implying bullish market tendencies. For our bullish outlook to continue, we would like to see a clear break above the 75.25 resistance level, with the next possible target for the bulls being the 78.65 resistance line. On the other hand, for a sideways bias, we would like to see the commodity remain confined between the 71.60 support level and the 75.25 resistance line. Lastly, for a bearish outlook, we would like to see a clear break below the 71.60 support level, with the next possible target for the bears being the 68.20 support base. That's a wrap for today's financial news. Thank you for tuning in. Until our next update, from all of us here at IronFX, we wish you solid trading.